Hello, everybody. Happy 2021. It is Mike Weller from the Weller Group at Keller Williams. We are here with our monthly mortgage minute with Momi Pointer. Hi, Momi.
Hi, Mike. How are you?
I'm good. How are you?
I'm doing well. Thanks for asking. Happy New Year. Happy New Year to everybody.
Happy New Year to everybody who celebrates New Year. So, which I think is everybody, but I'm not sure.
I think so.
So here we are, 2021. What's happening with mortgages? I haven't really heard a lot of mortgage news lately. I mean, certainly the rates are very juicy.
Yeah, well, you haven't heard a lot of mortgage news because there's been other news on the media, that the media's been reporting on, right?
Right.
But as far as mortgage news, we've left 2020 and entered 2021 pretty much with the same rates. The last few days, they may have clicked up a little, but analysts are expecting that through 2021, initially through 2021, rates are going to remain low. And even though they clicked up a little bit, they're still historically at all-time lows. But now analysts are saying that they're probably going to remain low through 2022. So it's great news for everybody, right, who still hasn't refinanced or purchased.
Great news for anybody who hasn't refinanced or purchased. So definitely a great time to take advantage of the rates. There's not like a super urgency. It's going to go up next week or next month or in February. So I don't think anybody needs to feel pressured, but at the same time, I think if you're looking at purchasing or looking at refinancing, it makes a lot of sense to lock in these low, right? With all of the stimulus that's happening in the long term, there's no way interest rates could stay this low. In the long term, inevitably, there's going to be a level of inflation that if you are locked in on your house at 2.5%, 2.75%, anything under 3%, even if you're in the 3s, I mean, in the long term, you're going to be great, I think.
You're right.
But yeah, as far as, refinancing, I'm just thinking of a lot of people have refinanced in the last year. Who would be some of the great candidates that might want to look at refinancing that haven't already?
Well, I would say this, anybody who purchased using an FHA loan last year, the year before, even in summer of last year, you probably have equity because prices have been going up, right?
Yep.
I mean, I'm hearing the next house sold is $20,000 or $25,000 more. I mean, not every single time, but if you bought using an FHA loan, get an evaluation on what the current equity position is, what your value is, what your loan amount is. You might be able to refinance into a conventional loan and eliminate or lower your mortgage insurance because conventional mortgage insurance is typically lower than FHA.
Right.
If you have a VA loan, you can benefit from a VA IRRRL, which stands for Interest Rate Reduction Refinance Loan. You can go to any lender like myself, and that's a no income refinance, so no documentation except your mortgage statement.
It's also known as the VA Streamlined. A lot of people will call that the VA Streamlined, right?
Well, I've heard FHA Streamlined. Yeah, you can call it a VA Streamlined, but most of us call it the VA IRRRL.
Gotcha.
Actually, anybody that refinanced last summer might benefit from a lower rate now, believe it or not. Even at the beginning of last year, where we thought rates were really low. I'll give you an example. I have a client who was high balance. Another good example is anybody who has a loan amount so now the conventional high balance is $822,375 in Orange County, LA County as well. So anybody that had a loan amount that was $800,000 or $822,000 that was going to be jumbo last year is now a conforming high balance and can benefit from the low rates.
Yep.
So those are all good candidates.
That's another good group of people that a refi would really help. People that were kind of on the threshold of the loan limit, depending on where they were, and now those loan limits have gone up here a little bit.
And not necessarily the loan limit, Mike, because the loan limit is definitely, a key factor, but jumbo guidelines are very different than conforming high balance guidelines, whereas, you know, a lot of jumbo people may not meet the reserve requirement.
Yeah.
You know, they may not meet the guideline.
It's a tighter box you have to fit in for that.
Yeah, for
Yeah.
sure.
Yeah.
Yeah. A lot more hoops that we have to jump through for
Right.
jumbo.
Right.
Yeah.
So,
I think I hit them all. I think if you have mortgage insurance, FHA or conventional, you definitely should evaluate either eliminating it or lowering it. I've done a lot of those.
yeah,
recently.
I think right now, like if you're in an FHA loan, I mean, unless you literally just bought in the last month or a couple of months, you'd be insane not to refi, or at least not to explore it. So, because chances are, you know, even if you only put 3.5% down, chances are at this point you have at least 5% equity. There's a decent chance if you bought a year ago, 3.5% down, you probably have the 10% equity to jump into a 90-10 conventional, and or 90% LTV conventional. So yeah, those people really should, and they'll save themselves so much money, both in the near term and in the long term. Yeah.
Yeah.
So.
I mean, I have some, this doesn't apply to everybody, but I have some FHA loans that I'm refinancing or have since closed where I was able to knock $500 or $600 a month off of their payment, even conventional.
Sure. Yeah.
Because we're eliminating the mortgage insurance,
Yep.
we're lowering the rate. Like you said, I mean, I have a client that I just locked high balance in the low twos.
Yeah.
Like, you know, lower than 2.5%.
Yep.
And it's their forever home.
Yes.
They'll never, ever, ever have to refinance again.
Right.
Unless we go below 2.
Right. So one thing I hear people say sometimes on a reason they don't want to refi is, you know, say they might be 4 years, 5 years, 8 or 10 years into their loan and they don't want to reset the clock. Can you talk about that?
I can talk about that. Thank you for bringing that up. So you don't have to reset the clock. You're in a 30-year and you have 22 years left, right? You can actually get, I can do any amortization term, 22, 21, 20, 19, 18, whatever. What I'm finding is people doing that, lowering their amortization term, I'm still saving them money per month, and they're dropping a whole lot of years off of their term and saving a boatload.
Right.
I don't even know how else to say it, a boatload of mortgage interest. And some will even go down to a 15-year because the payment is still lower than what they're currently paying.
They get an even better rate at the 15-year.
Better rate. 20 is where it clicks down and 15 is where it clicks down again.
Right.
Yeah, absolutely. That was a good point.
So so don't let that be the reason to stop you. And don't let fear of closing costs be the reason to stop you either. I think that's very short-sighted too, I think, a lot of times.
I think so, because I'm I hate to say it, but I basically say money's cheap right now. Don't you say the same thing? Money's cheap right now?
It is. That's what I was talking about before. So with the, in the long term, it's not going to be like this. So
and so if you roll your closing costs in and you're still saving money, it really doesn't matter. Another sector that I wanted to talk about, Mike, and I think you might agree, is a lot of my clients hold a lot of investment properties, and investment rates have always been much higher than primary residence rates or owner-occupied rates. And so a lot of my clients that have these investment properties are refinancing because they're getting rates in the low 3s or mid 3s. And these are rates that, think about it, last year were owner-occupied rates, but now you can get an investment property in the mid 3s and cash flow that property, really cash flow that property. Yeah.
So let me just clarify what I'm hearing you say, or one point that I think I heard you said. Has the gap between, you're always going to pay more for an investment loan over a owner-occupied loan, but has that gap shrunk, or that gap is still the same, but because rates are so low, like it's always about 1% higher?
A point. Yes, the gap hasn't shrunk. It's about the same. It's about a point difference. So if you're locking an investment property rate at, let's just say 3.5, you can probably get an owner-occupied rate, primary residence rate in the mid 2s.
Right.
So the gap is still a point, but you know, when have you ever heard that you could get a rate on an investment property in the threes and
Yes.
cash flow? So it's also prompting a lot of your realtor, and you understand the value of investing, owning investment properties and having them cash flow.
Yeah.
A lot of my clients that are familiar with that are now, you know, it's prompting them to purchase investment properties because they'll automatically cash flow
Well,
for the most part.
yeah, and I think that the mortgage on it is almost like, it's almost like an added benefit to the property. You know, I know some people are so, like, even like some investors that have the cash, like, oh, they want to buy properties cash and they want to have all of these cash, you know, they want to own these properties in cash. And with rates where they are and money being so cheap and low, it's actually a much better long-term play to finance them at these rates. And, you know, if you want to use the same amount of cash, leverage that into multiple properties, and you exponentially grow your portfolio that way.
Exactly.
That's what I would say and suggest. Yeah.
I actually agree with you. You know, if you've got, yeah, just why buy one all cash when you can buy three
Right.
and they'll
Right.
cash flow because the rates are so low.
And there's certain people, you know, like we often hear, you know, you'll hear a lot of like, you know, like the Dave Ramseys of the world, and people, you know, it's true, talk about like, well, debt is bad, that, you know, but there's a difference between mortgage debt on real estate and your car loan, your student loan, credit card payments, you know, consumer debt. Like if debt is being used as a tool in an investment, it's a
For
very,
wealth planning.
it's a very different animal. Yes, it's a very
Yeah,
different
I mean,
animal.
you're talking about
Yeah,
debt through a mortgage for your future financial planning and
right,
wealth planning versus you're not going to wealth plan or financial plan with credit card debt or auto loan debt.
right, right.
Agreed.
Well, and then also on the investment property, you're not paying the debt, your tenant is.
Exactly.
So,
Yeah, for the most
yeah,
part, yes.
yeah, that's the plan at least. So,
That is the plan. Yes, and pay down that mortgage. So
yeah,
yeah, absolutely.
okay. Okay, 2021. Well, I think we talked about more than we were maybe expecting.
Always.
So, yeah,
Isn't that how it works?
I think so. I think so. So, um, okay, well, if anybody has any questions on refining, on finance, on mortgages in general, looking for good recipes, whatever it is, reach out to Momi. Here's, you know, her numbers here on the screen, and we will check back in February.
Yep. Thank you.
All right.
Bye, everybody.
Bye. Bye, Momi.